Hi, everyone. Welcome to yet another episode of our biweekly webinar. I'm Dr. Fasanya, a pulmonary critical care physician and CEO of Dr. BDZ Capital. I'm your host today, and we have Dr. Ozoude, a direct care orthopedic surgeon and CEO of Time Health Capital. Our joint goal is to empower and help fellow physicians and high-income earners achieve financial and time freedom. Our goal is to educate and impact our audience with skills and investment knowledge to improve your lives and ultimately achieve financial and time freedom. A little bit of how I got started. I started in real estate when I was in Canada in my late teenage years in reassignment homes. If you want to know more about that, you can look it up or you can ask me later in the future. And then I went to medical school. And after medical school, I was in the residency. I was finally able to get some cash. And in residency, I was investing in syndication with little money that I have and moonlighting. And thankfully, they all did well. And then fast forward to fellowship, I was making even better money. So by the time I graduated, I had enough to buy my own property. So in early 2019, I bought my first 8 units. And since then, we've grown our portfolio in self-storage, multifamily, oil and gas, and commercial real estate. So far, we're about 170 million worth of asset under management and about 1,500 multifamily units under management. So I'm still learning and I'm still trying to gain as much knowledge every day. So I'm going to give it to George to introduce himself.
Hi guys, George Ozoude here. I'm an orthopedic surgeon based out of Houston, Texas. I own my own practice, 2.5 years now. It is a direct pay orthopedic surgery practice. And I am a real asset syndicator. And my journey started while I was actually still employed with my first job out of training and seeing the writing on the wall where medicine corporate model was headed. I became real interested and excited about the opportunity of financial freedom through real asset investing. I started investing in syndications passively. I've gone on to invest in 25 of them total. And now I'm a co-GP and have invested in 4 deals as a general partner through my syndication company, Time Health Capital. So I founded that about 2.5 years ago as well to help other physicians who I knew were feeling the same friction in the corporate medical model to have an avenue, an outlet for education and actual opportunities to invest in real assets. All in all, I've invested in over 4,000 properties as an LP, 4,000 units, excuse me. And then as a GP in 4 deals, I've invested in just under 900 units with an asset under management amount of about 75 million. And it ranges across multiple different asset classes from multifamily acquisitions of existing buildings to development projects of large apartments to mineral rights, which is a type of energy sector, oil and gas investment, medical office building, as well as farmland. So we really look at multiple different asset classes and ways to grow wealth, get cash flow, get financial freedom, and find tax breaks. One of the biggest pain points for physicians. And so we're really excited to have this particular talk tonight because it's about diversification. You heard my story, you heard Bayo's story. We don't just invest in one asset class, and that's for a reason. There's multiple benefits of diversification. And you'll hear 2 camps. You'll hear the camp that says, find one thing and lean in and concentrate your energy and your capital. And you'll find other camps that say, spread out the risk. Ultimately, I think it comes down to individual. What is your investment appetite? What is your risk threshold? And tonight, we're going to talk about those who are interested in diversifying because they want to spread their risks out. So we're going to get into it. And I like this segue because a lot of us are more familiar with the multifamily asset class, syndications particularly. And there has been risk in that asset class. And we need to talk about them because we just went through a very stressful period in this sector over the last 2 years with the rise in interest rates. And so a lot of the touting of multifamily as being so great and recession resistant really got tested. And I think finding out that it may not be the end all be all is super important. And so what do I mean by that? Interest rates went up over the last 2 to 3 years, and that's because inflation went up. And inflation went up because during the pandemic, there was a mass amount of not only printing from commercial banks, but actually printing from the government. So there's this injection of liquidity in US dollars into the financial system and therefore into the economy. As a result, prices got high everywhere and the Fed had almost no choice but to raise rates. A lot of the investments over the last few years have been bought with variable rate debt. And therefore, a lot of stress started being realized by these assets and these managers. Debt service went up because the interest payments on the loans went up. And even though there was financial and economic stress, which is supposed to be bullish for multifamily because people tend to rent when they're not as financially sound because they can't buy a home. But this actually presented a lot of stress for operators and investors in that asset class. So that's one thing we need to keep in mind. It's not foolproof, and nothing's foolproof. There's always risks. And I think this period made us realize that, look, we can't maybe just lean into multifamily the whole way through. We need to find out and understand the macro picture and understand different asset classes and leverage either operators who are very expert or get that knowledge ourselves so we can play in that space. And so I'd love to hear from Bayo on his experience. That's been mine over the past few years. Some deals did great in the run up. Some deals did pretty good through the stress. Some deals didn't do great at all. And it's been a great learning lesson. I'm glad I diversified from the get-go, but it even reinforces my belief in diversification. What do you think, Bayo?
Yeah, I agree with you absolutely. So there is a lot of risk that are inherent to syndication investment, right? And being an operator, I've had chance to go behind the curtain in many deals, right? And there are so many more deals, that, are just looking good on the surface that are still struggling, right? Depend on the communication of the operators. So yes, the risk exists. And diversification, I always believe in diversification early on, and that camp of, diversify early on until you get to a certain level. And then once you figure out which one you're best at, then maybe you can push a little bit more in that direction while still diversifying, but you basically maybe increase the percentage in that particular one. Let's say you're the one of the best builder, and after a while you notice like all your buildings are just killing it. Maybe it's time to start putting some in there. But then there's a lot of averages too, which means you might be doing so well and you then double down. And that was when your law of average is going to be due. And now you lost all your money. And that's the diversification, at least early on. It's my belief.
So with multifamily, there's not all that are risky that you have to keep in mind of is obviously the debt service, as I just mentioned, especially if you're dealing with variable rate debt and not fixed debt. There's on the side of the actual operations, there's delinquency and vacancy. There's delays in rehab, especially when inflation can impact the cost of supplies. And so your timeline can be affected, and that time is money because you have holding costs, you have carrying costs, you have a target that you're trying to hit. Rehab delays may be something that impact the experience that you have while investing. Natural disasters now covers supposed to cover things like natural disasters, but it can still be a stressful time period to navigate, right? It can still cause delays. It can still be just a hiccup in the process. Excessive fees, especially if you're a limited partner, that can impact how much return you're realizing, the true return that you're realizing. Even though, yes, you made the right call in investing in syndications, maybe the space is rampant with excessive fees that it's not as lucrative as you initially think. So you have to really look close at that. And that I call risk of the third party or counterparty. When you do syndications, it's not just you and your apartment building, it's you investing through an operator. And so that is inherent risk. Who is the operator? Are they someone who's honest? And are they someone who is charging excessive fees? Got to keep that in mind. And then there's other ones, and I want Bio to weigh in. Things like pause distributions and capital calls. What have you seen, Bio?
Especially recently, we've seen a lot of more pauses, and we're not immune to that. We have a deal of ours that we, pause holding distribution at this point also. So it's, but worse than that is capital call. So basically, capital call is a situation where the deal is doing so bad that you already, let's say, invested $100,000 in the deal. Now the operator is asking you, this deal is gonna die unless everybody bring in another $10,000 or $20,000 or $50,000
each.
And you often have a choice in the situation. Sometimes you don't, but oftentimes you have a choice. But no matter what your choice is, there's going to be dilution of your shares. So because that money is going to flow somewhere, and if you don't give the money, they're going to get the money from somewhere. So they have to give that person some percentage. So which means your percentage will be decreased. So, and that of course have a big impact on your passive cash flow strategy, right? So many of these deals, the equity can still be there. If they manage properly, they're able to save the deal. Many of them will still 2x or give the return. But problem is, if your goal is trying to replace your income, now you have a problem, right? So you're not no distribution for a while. But yeah, so definitely these are things that you actually don't have much control over because the operator will do what they think is best for the deal. That might include like post distributions and worst case scenario, capital call. I guess that's not worst case scenario. Worst case scenario is for the deal to actually just sell and they just tell you, sorry, your investment has been wiped out. I mean,
I think it starts with being very curious and being social, meaning you have to educate and then you have to network so you can learn about the different concepts and the different people, the different stakeholders who are in the space. That's a great way to lower your risk and increase your confidence. So start chatting with different operators and make minimum investment to start so you can get familiar with the way somebody works. And over time, if things pan out successfully, then you can reinvest with that operator or even invest more amounts with that operator. And so you grow with that operator. And then we'll definitely get into this, but you can diversify into other asset classes. Maybe now the last 2 years wasn't the greatest time to invest in real estate syndications, but guess what did well following the pandemic? Industrial warehouse. That was a huge hit. So if you could have had that awareness about what the macro trends are and then pivot as an LP, you have that luxury. Maybe not so much as a new GP. When you're a general partner, you almost need to focus and become an expert. But when you're an LP, you can leverage those experts who are in different spaces that are doing well when the markets are turning down. So that's a great example. We'll talk about more. We'll talk about the different ways to diversify.
Yep. So also before we go into the actual ways to diversify, is to, as a general rule, you should have a percentage split of your portfolio, which is personal financial statement or, to yourself that, okay, like for me, I decided on 40% stocks still, right? Actually close to 35% and 60% real estate. And then within the 60% real estate, then there's division of, okay, half of it is going to be multifamily. Then the rest is going to be 10% this, 10% that. So you can have an idea. We're still doing, at least I am still doing that. I have 401k, still have my emergency fund, still got some physical cash. I don't have precious metals. I think George has some.
I do.
Do
I
you?
do. I'm a fan. I got gold and silver.
So I know you're into those. So you just protect, and then I buy businesses too. There's multiple ways you could do that. So that's just a general way is for you to have your own personal financial plan to say, okay, this is, and then once your real estate, for example, there are a year that I had so much stocks in Tesla that it went up to about 60% of my portfolio because Tesla had a split, it went up like 5x. So what you do is either you start buying more real estate and no stock for a while, or you actually sell some stocks, buy more real estate to make that percentage back. So basically, you rebalance your portfolio. So that's another
I,
way.
are you using some software like an app to keep a tab and help you with the rebalancing, reallocation?
Because it's so all over the place, it's difficult. I used to use what is this personal capital. Now they change into Empower. Since they change into Empower, it's been difficult. So I just keep tabs by myself to just keep it. I do have about 5 to 10% of my portfolio in asymmetric upside play, and that includes venture capital. For $10,000 into this uncle or somebody that started the new startup. You don't want to put so much into those ones because you may never see that money, but you could 10x or 20x. So you have to just decide what's your risk
It,
tolerance.
it
But
could
yeah,
be it could be the next Nvidia.
right? The next penny stock. So
So yeah, there's many ways to diversify. Let's get into it. We already mentioned some, but we're going to start at the basic level. We're going to start with geographic diversification. So of course, it's a lot easier, a lot more comfortable to invest in your own backyard. We just closed last week on an investment property in Houston, my hometown. So it's nice to have that. But what if Houston's in an economic downturn for whatever reason? And does that mean other geographic locations are turning down? No, there could be some market growth in another location. So diversifying across cities, and we're not just talking about within your state, because Texas, where I'm in, has multiple markets that I could invest in. But I even go beyond that. I like to invest across even the Sun Belt and then even internationally, right? Because there's risk inherent in every level. There's risk just from Houston. They have their own local economy. Then there's the Texas state economy. There's their own, you even call it their own country. Texas is like its own country. Then there's the US and its federal policies and how they're different from other international markets. And trust and believe this is a global interconnected game now. It's not like US can just run their systems without any effect across the world and vice versa. So the things that are happening across the world affect the US. Got to keep an eye on that. Got to keep your eye on investments outside of the US as well. Not only for that reason, I can tell you I've made 2 international investments. One, well, I made one. I tried to make 2. One was a citrus farm, so agriculture. So that's one diversification in another country, Paraguay, so another continent. And then tried to make another investment in teakwood farms in Panama. And this had a special angle to it where I can actually gain residency after 5 years of the investment. So it had another angle. There may be other reasons why you want that diversification. And for whatever reason, some people may want to have access to multiple passports to be able to move around and again play that global game just in case. And so unfortunately that deal fell through. A lot of things fell in right at the very end, which I'm bummed about. But yeah, I'm interested in geographic diversification for more than one reason. What about you, Bio?
yeah, I think we were trying to do Belize. What happened to that?
Interested in Belize. I think Panama was a better option, but now looking hindsight, maybe Belize was the the better because Panama fell through. So it was between Panama and Belize because they're geographically similar and close to each other, and a lot of expats live there. So it's easy to transition if you want to. It just so happened that Panama won out and then lost.
Yeah, good. Because I think there was a residency angle to Belize also.
There is, yeah.
I believe. So,
Yep.
yeah, I'm mostly, stayed in Canada, because I was from Canada. I still have family there, doing a little bit of reassignment homes before. So I actually was involved in the construction, multifamily over there. And also we do buy some single family homes. Some of them we end up just renting them out. My mom, essentially. So I'm involved there. I look into Nigeria a lot, but the inflation is not friendly. So you have to look at that too, that as much as you're trying to diversify, you make sure that you have trusted people, obviously, that you don't just hand out your money and it's disappeared. That's one of the issue. But yeah, so far I only have Canada, but within the country itself, we do have multiple units in St. Louis, luxury senior living in St. Louis, Missouri. We close on 200 units in Kansas City. And then we have Houston, we have Oklahoma, we have lots in Fort Smith, Arkansas. Maybe I could do a better job, maybe in Northeast, but I'm still always skeptical about investing out
Well,
there.
the Midwest, there's a lot of potential in Midwest.
Yeah.
Then there's also property type diversification. So within real estate, we throw that term around very loosely, but my God, there's so many different businesses you can put on a piece of land, right? It just so happens that the more popular one is a residential business, right? Apartment buildings. But that real estate can be home to a commercial property, a retail property, an office building. I mentioned industrial warehouse before. It could hold a medical office, a hospital, a surgery center, which I've invested in before. Could hold hotels. So you can diversify across these different asset classes. Bio has different types of real estate, and they come with their individual risks. They come with their individual independent market factors and cycles. You got to see where the puck is headed. Maybe now is a better time to look at residential assisted living. Why? Because you got a huge baby boomer population that is going to flood that space. So you're watching the macroeconomics and making a decision, right? What do you
Yeah.
think?
Yeah. I think you don't have to do every one of them. Like we
Right.
talk about, I think I read somewhere in Bigger Pockets. I always mention that article. It says there are 100 ways to make money in real estate. So you could literally, just within real estate itself, you can go nuts. How much you want to get involved in. But you should learn as you go. So we've done multifamily, obviously, different type of multifamily. Then we've done luxury senior living. We've done oil and gas, which is like a land slash, mineral rights. And then we've done self-storages in a warehouse and also office. We have few offices, both storage, even within storage. So I think it's not so far away from each other. We have not tried short-term rental, but I'm still watching the space.
Yep, I've played in that space before. I'm actually looking at a potential opportunity where there's something called industrial storage, where you literally have these big commercial type of vehicles that need to be put somewhere, similar to like boat storage. But
Oh,
yeah, you need place to like put a big, what
like
do they
tractor,
call all this equipment,
mi-
construction,
military equipment, maybe, if they
okay?
don't put in the barrack. Yeah.
So many different ways. Then there's diversification across your strategy. So you can not just invest as an equity partner, you can invest on the debt side, right? You can just actually be the bank. You can have a strategy of holding long term where you cash flow, get that financial, that true passive income, financial freedom, and you just refinance every time. Or some of your allocation could be into flips where you're quickly turning over the money within a year, less than a year.
I
Or
know
you have
Timmy.
medium,
I
what's
know
that?
Timmy. Timmy she's been all in that. You can tell us later if you once you have the time how that is going.
And I think a big thing here is just you don't necessarily have to pigeons hole yourself into one box. There may be reasons not only depending on what the return profile looks like and what your personal goals are, but also that can change over time. Like a doctor at 35 versus a doctor at 60 can have a different set of criteria and goals. And that can cause a shifting or reallocation of where they're concentrating their investing.
That's true. Your risk is less. Like there are some deals I look at and I tell George, I'm like, who's going to invest in 12% IRR deal? And George, if you're 55 or 60, you're close to retirement, is a very safe deal with very little return, but more safe. Maybe that would be your the thing you're looking for. And triple net might be your thing now.
Right.
No trouble.
Maybe you have a bigger pile of money that you're allocating to that asset class, so it makes up for what you're looking for, right? It's one thing if you're investing 100,000, but it's another if you have 10 million to put into a deal.
So basically diversify across each sector. Each one has its own cycle. Right now, office space is having some issues with the cycle, right? Whereas industrial and some retail are actually doing better. And then self-storage had its own dip, and now it's coming back up. Multifamily had a dip, it's coming back up. So
right. You can do crowdfunding or you can do private placements. So you can play in the public market versus the private market. So on the private side is these things where you own it yourself or you do a syndication, or you invest in individual deals versus a fund. There are different risk profiles and return profiles. Or you can play in the public markets where you invest in crowdfunding. You get crowdsourced or you invest in a real estate trust, which is a real estate focused stock in essence. But it's a publicly traded and it has its own risk profile.
Yeah. I have investors that tell me they absolutely want everything to be real estate. So I'm like, okay, here's a way for you to be almost like stock, but real estate. So REIT. And so you can buy land. That will almost be like gold. You're not doing anything with it, but you're just keeping it to keep the value and hopefully appreciate a little bit. There's different ways you can play even within real estate itself and substitute for some of the other sectors that you're looking for.
And even though this is a real asset platform, there are opportunities to invest in paper assets. We already mentioned you can issue debt for real estate or any type of asset, but you could also buy notes. So these are paper assets and they're options as well. If you don't want to actually own the actual physical asset itself and just get a steady return, you're first in line usually. So you're lowering your risk profile and you're getting a monthly interest payment, dividend, principal. Set the clock and just you're getting it, right? Unless there's some issues, but that's an option as well.
Mortgage-backed securities. You can even do some virtual real estate now in crypto. If you really want to just make it real estate, 100%. So we also have a sector diversification. I think we can already talk about that, which talks about subsector like office, retail, industrial, healthcare. Are you involved in office? Are you involved in any of the healthcare investments?
Myself, one of my first and probably my best return on investment was a surgery center.
Okay.
So healthcare is going nowhere. It'll always be here. I think it's one of the best asset classes you can invest in. And so, yes, I haven't done office building, but I've done essentially medical office building, and I look for more. We're even looking at another one right now, an ER in North Texas. So
I like to see how that goes. The only way I've done that is for me is my office. I bought my office, and on paper, it got some appreciation, and I get to pay myself rent. So that's some way to enjoy that kind of a little bit of diversification into that segment.
Yeah. And then, so there's size of investment. So you can play in a space where it's very large and you maybe have to pool capital or work with other people just to gain access to those sizes. Or you can play in a middle tier, or you can play in a small where you can get the deal yourself because it's accessible. You can afford the down payment. This has many reasons why you would do one or the other. If you want to grow your own private portfolio where you can have control, you may want something smaller. And something you can handle, especially a lot of us are physicians. You may not have the time to take on an overwhelming 400 unit property, but can you do 4 units in your backyard? Single family, Airbnb, some of them, long-term rental, mid-term rental for some of them. Maybe that's something you can handle and you can pass it on to anyone. Generational wealth, a little easier. It's a little more simple to actually pass on the real asset, not just the paper currency. Then there's mid-size, where maybe you start joining small group, 5 other people, joint venture. Or maybe you want to grow a community like we're doing right now. We're not just interested in having the title of owning 1,000 units or 2,000 units. We're actually interested in bringing other of our friends and physician colleagues together and forming a community. It's hard to do that with smaller deal. We've tried to consider, can we syndicate $2 million deal? The math doesn't quite work out, but we can syndicate a $20 million deal and help some of our friends because we know what they want, because we have similar goals and we're interested in not just money, but forming community, like-minded groups.
Yeah, absolutely. It's not just about, so that's part of your personal financial goal too. It's not just about that. Do I want to invest in things that help the environment or things like that? Those are all those things that you have to align your personal goal with your investment too. So to make sure that this is, you're also having fun while you're investing. So for us, it's doing what we do now. We do enjoy educating other people and also growing together. Many people that we met in the beginning of the journey, some of them have done their own syndications now. Some of them have bought their own property, and we're very happy for them. In terms of the size, so for me, I've played in multiple different sizes, right? So right now in my portfolio, let's see if I could share the screen. Oh, by the way, this is our book, #1 Amazon bestseller, and you can get it on Amazon. If you look at this, you can see, especially in the beginning, right? There are some 4 units, 12 units, 8 units, 12 units, 12 units, some 5 units.
Before you go on, just highlight it. You can click on the number 5 slide.
Oh, okay, hold on. Okay.
There you go. And make it bigger. Yeah.
Is it working now?
No.
Okay, I'm gonna just enlarge it this way then.
Yeah.
This always happens sometimes. Okay. Okay. You see?
Yep.
So when I go down, you can see you can see the progression also. So let me see. Okay. I think this is the best I can do. Okay. Are you able to see it?
Yeah.
Okay, a little bit tiny, but it's just for illustration mainly. So you see, so a lot of 8, 4, 12, 12, 12, 9, and now we started going into, these, and then we did some with our joint venture ones, will be smaller deal, and that one will be easier to manage, with few people, maybe only 10 people in the deal, maybe 5 people in the deal. There's a self-storage, there was only 2 of us in the deal. So you could do it that way. And there's nothing stopping you from doing multiple of these. There are people that want to only do large multi-family, okay? But for me, a deal is a deal. It's an awesome deal, and it's only going to take 3 of us to get it done, and that's fine with me. You don't then have to syndicate it. Then you can just do a joint venture on it. So yeah, so just don't, decide what kind of strategy you're looking for yourself, and then, and then you can look for those kind of properties. The larger properties, sometimes you only own 0.5% or 1% of the deal. Maybe you're not happy with that. You can do a smaller deal where you own 25%. So it's up to you.
Yep. And another thing about larger versus smaller groups is you can leverage those partnerships, especially if you're beginning, to tag along with someone who has more experience. And now it's just like residency, where you got like the mentor or a very strong, experienced group that you get to learn under. And this is true even as an LP. I've invested in so many deals as an LP, and I got to learn because I would follow the reports, ask questions. But even if you're a small joint venture, Maybe the lead person is someone who's very experienced, and now you get to learn under them. So there may be other benefits, educational benefits that makes you stronger for maybe 5 years down the line. Now you're doing your own deals, or you're the lead on either a JV or a syndication.
Yeah. I think you're more likely because there's four of you. I'm pretty sure you can just get on a phone call or text or even locally. Like this deal is local. So every month when we do the review of the property, we just meet at the property just and we go there, go grab some drinks. So it's become like a social and relaxed thing for us to do, you know? So, and I love it. I love the deal more than just the for money. Just the fact that we're just both local people. We meet up, we got some drinks, and then we go drive to the property. We take a walk around, talk to some people. Yeah. And then, of course, he can learn whatever he wants to learn and ask me questions easily.
For sure. You mentioned it before, but you got to identify your own goal, whether you want to get passive income, whether you want to just continue getting your physician income and just grow your wealth, that's capital gains, whether you want to just try to get your tax burden down to zero, or maybe you're later on in your career and you don't want to take too much risk and you just want to preserve what you have. You don't want to lose it in these crazy markets. Not only do you not want to lose what's in the bank account, but you want it to at least keep up with inflation, because that's now becoming more and more of an issue, and I don't think it's going to go away. So that's going to have to be on people's minds now. Maybe 40 years ago, that wasn't an issue. Your conservative returns probably were beating inflation because there really wasn't any. We were in an interest rate declining environment. But now I can't imagine that everyone has to at least consider it and think about it to some degree. So you need to define that and allocate your capital accordingly.
Yep. So a few other things we talk about is use of partnerships, right? Even if you're a syndication company, you can join another syndication company in a deal, right? And bring it together, which is what we did to bring about the 405 units in Houston. You even for a personal one too, you can find a deal, let's say $1 million deal, you need 300, 400,000, but you have 200,000 and you have a friend that can bring 200,000. That's a good JV right there. Be like, hey, let's do this together. So there's, other ways. And the risk profile for that is different from the risk profile for syndication, because now you have control on that one, but then you take the risk. But for syndication, less control, but you're taking less risk. Kind of balance yourself out that way.
And then outside of real assets, like I said, this platform for sure, we love our real assets, but even outside of real estate, real assets, you can still invest in paper assets. We mentioned REITs, that's still a real estate play. We mentioned debt, but stocks, bonds, Forex, that's still game. I still have some investments. Now, I will have mention the caveat that I invest in commodity stocks. So I'm not in tech, which is obviously the hot play right now. But it's still officially in stocks. And maybe some point, and once I fully understand it, I'll invest in bonds. And even though it's not my preferred, I still want to have some allocation in that space. And yeah, that's another example. You can go outside of real assets into paper assets.
Yeah, especially now. You never know which one is up, which one is down. So I say, just I find the percentage. I used to be, of course, we all start with stocks. I used to be like 100% stocks. Then real estate became 20%. Now it's 60%. Then at one point, I talked to George. I was like, George, I have all this 401k when I left my job and start private practice. And I can either move them over to rollover IRA, roll over into Vanguard, and just continue investing it as stocks or invest it in real estate. And I'm still deciding. So, but then that would mess up my diversification. Then it's going to be like 80% real estate. But you have to decide what is acceptable to you. So in those kind of things. And I think the last part is do a regular portfolio review, just like I told you I was doing, right? After something changes in your life or one of your investments had a home run, right? there's a deal I'm invested $500,000 right now. If suddenly that deal, did a home run and I'm getting like $1.5 million or even back. So then what? So now it has messed my percentage up in real estate. So then I can decide to be like, okay, I'm going to hold off on deals for the next 6 months to 1 year while I do other asset classes. I do more mineral rights, oil and gas, buy more businesses, while I rebalance. So I would, advise you to do that. And you can change your personal financial goal. You can, whatever statement you wrote down, it's yours. You can change it, and be like, okay, now I want to do 100%, real estate. There are people that are doing so. I think George moved a lot from stocks to real estate,
Yep.
right?
Yeah, with being an employee, you have limited options with your retirement accounts, and it was good. Hey, it had a match. I maxed out, and the returns were good, and I left in November of 2022, exactly when the thing went down. But obviously, it's back up now, no issues. But I did pivot. At that point, I was more interested in developing relationships with real estate, real asset syndicators. And now I started wanting to get that relationship capital with my 401k. I rolled it into a self-directed account. And now I control where it goes. And that's been very helpful because I've been able to invest in deals with folks who've made good returns. And now I have a relationship with them and possibility to invest with them again. Come on and partner with them. Would not have been able to do that if it just limited to stocks. This is a great example of how you can play differently. And I can still get some of the returns from the real estate now in the self-directed account and put them into stocks, put them in back and rebalance. But I had a specific goal and I used the instrument, the tool to go after that goal.
Yeah. And it goes tax-free, right? At least.
Gross tax free.
So you just leave it. So whatever return you get from there. But I think you lose some of the tax advantage, right?
Yeah, you trade it.
You
So
trade
you
it.
trade one. You can't double dip. Or
Yeah.
maybe there's some creative way that a very good CPA can figure out, but you're just trading one for the other. Yeah.
Okay. So you just have to decide what your goal is. That's about it. You have anything else to add? We have John and Chidoze. If you guys have anything to add in form of diversification, how have you guys diversified your portfolio? What's your percentage? Like, how do you decide?
Yes, sir. For me, thank you for this meeting. For me, I'm majorly my food is majorly into real estate, right? I'm gonna say like about 85% is into real estate, and I do have a 401k with my company. There's a book I read about portfolio. I'm just doing S&P 500 and one other one for total market and one for bonds. So those are just where all the money is going into. And then I have a life insurance policy, IUL, that has like a cash value component part of it. The good thing about the life insurance, I'm just like 12 months plus into it, still learning the vehicle. Obviously, it has the death benefits to it. But the good thing about it is that you don't actually have to die to be able to dip your hand into your policy. So assuming that you lose your job, you can actually dip your hand into it, or you have a critical illness, you can dip your hand into it. I thought that was a great deal to be able to keep family stable if anything happens on the short term. So yeah, I have that one, and those are basically the three areas. I wanted to start diversifying like almost immediately, but I was watching a video by, I don't know if you guys have read Alex Hamosi. He wrote a book called 1 Million Offers. Is it 1 million? Something offer, and then another one for leads. So he was explaining the whole concept of trying to specialize before you diversify. So if you specialize on one, and he used a very graphic image that really planted it in my head. So he has like a jar of water, and then he was like laid out like 10 cups, which represented like 10 different income streams. and he was pouring a little bit into each and every one of them, and none of them got full, but he just focused on one and then poured all the water into one until it starts to, yeah, that's it. 100
That's
million.
one. 100 million. Okay.
This book is mind blowing. So he wrote that one and 100 million. The guy is really great. So yeah, and so he was explaining that in terms of specialization, if you specialize in one, you will get to a point where the cup overflows, and then you can use the cash flow from that particular one asset class and point to the other ones. But that was a unique concept for me. And he's been a great guy. Like I go on YouTube and listen to him. I know Dr. Bayo, you were talking about what's this Ken McElroy, that you listen to him quite a lot. And
Yeah.
I started listening to Ken McElroy too. Very good content on YouTube and all that. So yeah, that's my plan so far, investing wise. Thank you.
Yep. Thanks. It's definitely true the rule of thought. Like Mr. Wonderful? Is the one that always saying you don't need to diversify at all. So it's like to find something and just dig your head and just go
Yeah.
until you die or
Yeah.
make it. And those are people that become billionaires, to be honest with you. However, having 3 children and family to feed, I decided on the diversification route. Yes, I've had that before. Specialize first, especially when you don't have a lot to lose, especially, and then diversify later. And I've heard about diversify first, figure out what you love the most or what you know the most, and then start deep, slowly going into it more. So I think there's many ways to skin the cat, like they say. Not to natural cat. It's a figure of speech. But so there's many ways to play this game. And at the end of the day, as long as you have an idea, have a goal,
Yeah.
you're executing your goal, and if something's not working, you went to pivot.
I think another thing that is good is also go with what you feel right for your own investment philosophy. Like when I sit in the room with people like the guy will be like, sell your house, sell your house and invest in an apartment. I feel like, why am I selling my house? I should go rent so I can. So he's just like a very hardcore cash flow guy. You understand? So I just cannot do that. I have to do what feels right for my own investment criteria. Yeah.
Yeah.
I agree. There's really no right or wrong. There's many ways. You have to just understand yourself first, what you want first, and then thank God there's many ways, because imagine if there was all these different personalities and there was only one way to invest. that would be very unfortunate.
Yeah.
That's true. Yeah. Hey, eventually, every one of them is successful, and everybody have survivor bias, obviously. So, however you may, but I can tell you, when I talk to billionaires, though, they always talk about only one thing, only I bet few, and then I always think about them giving me some very interesting, crazy ideas of how to become wealthy. And almost always, they always tell me one thing. One of them just say, buy land. I'm like, what do I do with this information? That's it. That's the way he did it. He bought so many land, and then it has actually passed it from generation to him, and then he bought more. And then he held on to it, and now the guy's like in the 70s. But what happened is we have a subdivision now. Like he built like a subdivision and basically very expensive areas around his land. So I got it for penny on a dollar, but now but some of it is love too, because I'm like, how do you know development is going to come to that area? I say, I just hold on to it long enough. And then now the whole place is like they're buying for $100 million. The land there's a school in my area now. It's like the land, we have 0.3 acres. And this is for Smith, Arkansas. I bought the land beside my house. And then now people are asking, can I buy for 100K? It's like a small, tiny little 2.3 land. But then this guy used to own all of the area before. But I kind of just find a way to talk to him on a coffee. And I just said, just buy a lot of land, man. I'm like, can you give me something? Give me more, something to blow my mind. So I'm just saying, people will say things like that. And the other guy was like, buy gas station. So basically, it's whatever they did that made them successful. And they just tell you that.
Love it.
You got to pay your own race.
Yep.
So,
all right.
Well,
We're
thanks,
at the
man.
hour. We want to thank everyone for coming on. Thank for the contributions. John, thank you. This has been a good talk. We'll be back in 2 weeks with a new talk. We're going to be bringing on some more guests, so we'll be making an announcement of different guests that we're going to bring on for the second half of the year. So we're really excited about the bi-weekly webinar. With that, we're going to be, yep. Any last words, Bio?
No, thanks for everyone. And then we're going to be posting on YouTube for people that can't make it. And then, yeah, in a couple of weeks, we'll see everyone again.
All right, guys. Everyone have a good night.
Take care. Bye.